Welcome to another special edition of Mwango Spaces. This day kicks off bank earnings seasons. Kenyan banks are supposed to report their financial year 2023 results by the end of this month. And Stanbic Holdings is the first to report earnings. Very solid earnings today. So very interested to see how that goes. So we're going to discuss the results with Dennis here, who's going to take us through them for around 30 to 40 minutes. And then after that, we'll open the floor to questions from the public. So get your questions ready and send them to us. I'll get started by maybe Dennis introducing himself. He has a special title, which is unique in the sense of such usual that you find a CFO who's called a CVFO. So we'll get started with that and then we'll go ahead. So Dennis, maybe introduce yourself and your title a bit.
Good evening. Thank you very much for having me. Thank you, Bwana Mokaya. Good evening to all that have managed to join. I scanned through and I saw some familiar names. Catherine is here. Catherine is my external relations boss, so I'll need to be in my best behavior. My name is Dennis Musau. I look after finance and value management for Stanbic Bank in Kenya and South Sudan. Stanbic's operations in South Sudan is a branch of Kenya. It's kind of one legal entity, but in two geographies. I know there's an interest on why CFBO and not 4, which is common. If you're interested, you can look at my LinkedIn page. Actually, I did write a story recently, not more than 2 weeks ago, about the transition from traditional CFO role to CFUs. But because you haven't had the benefit to look at that, this is not my creation. This is Standard Bank's way of calling out the role of finance officers to steward strategy formulation, strategy integration, go beyond numbers to think about sustainability of businesses, think beyond today, and think about what is going to shape the business that is being operated through generations. So it's just expanded finance into kind of sustainability, kind of value creation, etc. Mokaya, I think that's probably good enough for now.
Yes, that should suffice. But then what's your relation to the group that is based in South Africa? So maybe you can tell people a bit about it.
Oh, fantastic. That's a good question. Of course, Stanbic Bank Kenya is in Kenya now and South Sudan combined as a legal entity folds up into Stanbic Holdings PLC. Stanbic Holdings PLC is a listed company in Kenya. That listed company has 100% shareholding in Stanbic Bank. It also has 100% shareholding in SBG Securities, which is the biggest equities broker in the market with 41% market share. And it has 100% shareholding of Stanbic Bank Assurance Intermediary Limited, which intermediates insurance protection for our customers. And then it has, through the Stanbic Bank Kenya, also shareholding in the foundation. So that is what forms the Stanbic Holdings PLC house in Kenya. That house is then held 74.92% by Standard Bank Group in South Africa, the biggest banking group in Africa. And the remaining 25.08% is held by a couple of institutional, but also listed in the NSE in Kenya.
I have alongside me here, Rona. So maybe you can give us a bit of flavor on what you're expecting at least for earnings season yourself in Kenyan Bank.
Okay. Thanks, Eric. I'm a bit caught off guard. I wasn't expecting that. But look, Stanbic's numbers that we've seen today, they were relatively good. We saw strong growth in earnings on a year-on-year basis. From what I can see, was driven by higher margins, very strong balance sheet growth, and strong performance on the non-interest revenue side as well. Based on this, what can we expect for the rest of them? I think if you look at the numbers that the banks were reporting for the first few quarters last year, Stanbic and I guess some of the multinationals were outperforming their peers. So the good performance by Stanbic, I don't think necessarily means we'll see similar numbers for the rest of the sector. Like I said before, I think some of the multinational banks, ABSA, potentially Standard Chartered also should report reasonable numbers. As for the sort of banks that are more locally owned, their numbers were relatively poor, as we had discussed in previous spaces. And so from their perspective, I'm just hoping for things to stabilize a bit in the last quarter. In particular, and from an asset quality perspective, the trend was pretty negative in the first 9 months. So I'm hoping to see at least some stability, if not an improvement.
Any end of kind of concern for the banks that they raised in interest rates in the past year? So has been a bit of a drag on some of these banks. Any other risks that you're noting maybe that you're watching out for? Any other things that you're watching out for? in the bank's earnings season?
Sure. You mentioned rising rates. It was a bit of a peculiar situation for Kenyan banks last year, both in the historical context and when you compare them to peers, because globally, when you look at the banks, the high interest rate environment has resulted in significant expansion in margins and profitability. But that wasn't the case for the Kenyan banks last year. Given the high interest rate environment, what we were seeing is the cost of funding was increasing faster than their asset yields, which, like I said, is unusual when you compare even to the historical performance. So that's something that, again, I'll be keeping an eye on to see how the margins have evolved in the last quarter and the guidance from banks in terms of what to expect this year. And I guess a follow-up on that is just what impact the high interest rate environment is having on their NPLs. I briefly spoke about it. The trend was negative throughout last year. But I'm hoping with recent indications that the economy is starting to stabilize with a bit more positivity around the shilling, hopefully we've reached peak NPL. So those are the two key areas.
And in terms of the exchange rates and the impact on some of the earnings, because I know banks have been feasting a bit on the Forex income for the past 2 years or so. What's your expectation as we head into the season? I think the correction in exchange rate came post the end of the financial year in December last year. So I guess last year would still be a feast for most of these banks.
Yeah, sure. And I guess we've seen a bit of that in Stanbic's numbers. The shilling continued to remain fairly volatile going into the end of last year. Spreads were pretty wide. So in that environment, banks' FX trading revenues will continue to remain robust through the rest of the year. Like I mentioned, Dennis will speak about it more, but we saw some good performance on their FX trading revenue side. The other aspect of that is the devaluation also inflates their FX denominated portfolio. Again, as you noted, Stanbic reported strong growth in loans, and I think partly that's driven by the devaluation of the shilling. So that also helped. So yeah, going into the end of last year, like you mentioned, the shilling was persistently depreciating, volatile. And I think we'll see the positive effects of that from in banks' earnings. But some of that could potentially reverse in this quarter, given the recent exchange rate movements we've seen.
Let's get started with the numbers, Dennis. Maybe you can give us a broad overview of how Stanbic Holdings performed in 2023. And then we'll dig deep into the segment as we go along. So a broad overview of how the performance was in 2023.
So revenue went up 29% for us. 29% is broken down into net interest revenue, which went up 35%. Included there is interest income, interest expense. You can open up that if you want. There's non-interest revenue, which went up 19%. In there is fees and commissions income. There is trading revenue. That's non-interest revenue. We can open up a little bit in the fullness of time. And then there is efficiency. So revenue goes up 29%. Our costs went up 20%. So that gives you a positive jaws of about 9% and improves on your operating leverage. But if I look at that cost measure, look at cost to income ratio and look at a longer tail from 2020, our cost to income ratio in 2020 was 52.2%. And through the strategy that I spoke to earlier, we managed to bring that down to 43.5% in 2023. A big part of that is extracting efficiencies from the investments we've made, but also pulling and ensuring that we increase productivity across the grid, whether it's investments in our people, investments in technology, and investments in internal processes. Then there is cost of risk, which is the credit loss ratio, credit impairments at 2.35%. That compares to 2.21%. So pretty much in the same geography. It is also indicative of the environment that we continue to operate in. We're quite comfortable with that, given it is within our risk appetite internally. And that all that summed together gives you a profit after tax of 12.2 billion, which is 34% up year on year. And I was reminded earlier today that makes us join the 10 billion club. Yes, that's a positive thing. ROE at 18.6%. RONA could like this. If I go far back to 2020, our ROE was 10.3% in 2020. We improved that by 300 basis points to 13.3% in 2021. We moved it up at 200 basis points to 15.3% in 2022. And now we've gotten a 333 basis points up to 18.6%. So quite comfortable with the play that we've done there. That's really just a function of ensuring we're optimally capitalized, but then on the other side, generating returns out of that capital. That gives you earnings per share of 30.75 shillings, up from 22.92 in the previous year, and the directors were pleased, subject to shareholders' approval, to declare 50% of that in dividends at 15.35, noting that 1.15 of that was already paid in August as an interim dividend. So the final dividend is 14.2 per share, and that full dividend is 22% up on 2022's 12.6 shillings. Maybe I pause there. I'm sure we can open up the balance sheet, but so that it's not a monologue, I can pause.
Let's start maybe with the loan book a bit and the asset quality side. The loan book did grow a bit, 30% plus in FY23. It's quite a substantial growth. What's driving this kind of trend in terms of loan growth and generally the asset quality? If you can speak a bit, maybe later we can discuss the NPL, but let's start with the loan book side.
This is a function of the numbers that you see vis-a-vis the numbers that I see. I do recognize the 30+ percentage that you're referring to is probably the Stanbic Holdings PLC numbers, which is loans and advances to banks and customers. So it combines two broad categories. The actual growth in loans to customers was actually 10% year on year. We grew our loans to customers from a net of 235 billion to 261 billion. I know in the consolidated abridged version, we do combine those with banks. There's another big jump in interbank placements, which actually went up threefold between December last year to December 2023. So if I then focus on the customer loans, we observed three interesting perspectives. The first is we observed a shift in a little bit away from term funding. Our customer loan book in 2022, term funding was 75%. As at the close of 2023, that term funding was 69%. So we did see an uptick in short-term facilities, be they trade, be they overdraft, etc. And that's subliminally linked to the credit appetite that we've seen from customers. We're seeing more and more customers are borrowing on the short end of the curve, given where we've seen rates. The second thing we did observe in our customer loans profile is a shift from FCY to foreign currency to local currency. When we closed 2022, loan book was 48% Kenya shillings and 52% foreign currency, particularly or predominantly the dollar. We closed 2023 with a 15 percentage points shift, where local currency is now 63% compared to 37%. What has happened there? We saw two things. One, we saw some customers come to us because of interest rates rising, especially on the dollar facilities. We saw some customers come to us to seek to convert to Kenya shillings. The second observation we made there is because we bank the oil majors, the oil marketing companies in Kenya. Because of the G2G arrangement, demand now is on the Kenya shilling side as opposed to FCY, because they need to fund their escrow accounts to accumulate the Kenya shillings to buy dollars and therefore settle the LC facilities. So we did see that shift come through. It was slightly muted by what I caught the last piece of Ronak's comment around currency depreciation. So was the currency depreciated by about 26.4%, I think, in 2023. And therefore, just holding everything constant, we did see the FCY balance sheet grow. If you allow me to just speak quickly about customer deposits, excluding interbank deposits went up 18%. Quite pleased with that, actually, given the competition for funding. Whether you think about this in the context of government borrowing, you think about this in the context of higher interest yield that can be earned from various investment opportunities. We did still record decent growth in our customer liabilities. Now, what's important to note, however, is that last year we reported current and savings accounts, which is your kind of traditional funding sources. Last year, 2022, that was 86% of our customer deposits. That number came down to 76%. So because of the increased interest yields or interest rates, we saw more and more customers actually wanting to migrate to fixed deposits or go and chase yield elsewhere. We did see that shift. Maybe again, I'm going to pause there, take any reactions, get direction.
Ronak, are you satisfied with the responses on loans and advances?
Yeah, if I may just maybe one follow-up question, FX related. Dennis, sorry, I'm going to put you on the spot here, but obviously quite a topical issue right now in Kenya. For your internal budgeting purposes, what year-end exchange rate are you assuming or forecasting?
We closed 2023 at 157 dot something. I think that was our internal rate. We had projected 2024 to be in the middle of 160s. I could be wrong, but it's somewhere in the region of 162 to 165. Given some of the sentiment we had gotten, our market research team had gotten us there. Of course, where we are today is our own different geography, and therefore we're having to reflect on what that means. Yeah, so Ronak, maybe so that I don't set my own question. So we thought it would be around 160, 162, 163, I think. We are now at 145. But hey, it is day 66 or 365. So it's still a little bit of distance to run.
On NPL, quite a raise in terms of loan loss provisions. If I look at the group level, there is 26% up to around 6.2 billion. So how is that working vis-a-vis the loan and advance of growth? And then also I want maybe to reiterate to the audience something that you spoke about, that two trends that you've seen, more shift from foreign to local loans and then more loans on the short end. So I think that's important for people to keep in mind. That said, back to you in terms of NPL trends, what do you observe from your customers in 2023?
I'll talk to NPLs and then I'll talk to the provision numbers. Again, I will try and clarify why some of the statistics might not entirely follow a trend. So on our non-performing loans ratio closed at 9.47% in 2023, compared to 11.09% in 2022. Depending on when or how I spoke or if we might have interacted previously, you might have seen a 9.07 in 2022. I have noted that in some of my presentations, that 9.07% was a net of interest expense. So the gross NPL ratio is actually 11.09. For parity, if I do net of interest expense in 2023, the NPL ratio would be 7.51. Generally, we saw our NPL ratio come down. Our appetite is to keep that a single digit at less than 10%. We do think when the industry is at around 14.8%, and that has gone up in 2023 from where it was in 2022. I think 2022 closed about 13.8%. We do think that 500 basis points below where the market is around a good risk profile for the bank, so that we're not taking risk, but also we're not taking too much risk. How did that shift during the year? Of course, we saw some names cured during the year. We did see some new NPLs coming to the profile. Those new NPLs were particularly in the commercial sector. There are businesses that have really been impacted. And if you think about the tale of 2020 to 2023, a lot has happened to businesses, whether it's supply chain disruptions, whether it's business model changes, whether it's the cuts from inflation, currency pressures, interest rates. There are businesses that struggled. So we did classify some names into NPLs in 2023, but also we did write off some of the sticky NPLs, names that have been there for a while, especially in the unsecured area, to the extent that we don't think, or we think it will be an inordinate effort to recover the money. We've gone ahead and written off those. In some of the secured spaces, especially for material loans, we look at what is really realizable so that we do take partial write-offs where necessary. That is how we ended up at 9.47. So a mix of cures, new NPLs, and a bit of write-offs. Now, coming to the credit impairment charge, again, you spoke to a 62%. I recognize that number. Let me try and correct it. Now, the way the CBK return is set, because you're looking at the bank results, the way the CBK return is set is such that any recoveries of previously written off loans do not go as a debit to the loan loss provision line. They go as other income. So when you look at that return, you will see other income went up 4x, moved from 500 million in 2022 to 2.2 billion in 2023. A fair chunk of what in that number is actually some coverage that we made in 2023. And therefore, if you now look at IFRS-based provisions, which is what in the group results, payments went up 27%. What explains that? So I did mention that we saw some stress in some of our commercial customers. We did see some challenges for personal loans. Where is that stress coming from? If you are employed like me between December 2022 and 2023, you're probably paying more for your Sukuma Wiki because of inflation. If you have a home loan, you're probably paying more because rates have gone up, and you're probably paying more taxes depending on your earnings bracket. Combine all that in a wallet that hasn't necessarily expanded significantly. We did see that effect come through. There's a question that I anticipate in terms of the brackets, and this will come from Ronak, so let me answer it. So in 2022, if I break down the loans into the three stages, 11% was NPL, about 8% was stage 2, so what we traditionally called a watch list. So you are not quite impaired, but you've shown signs you could get distressed. And then 81% was actually stage 1, so performing normally. In 2023, although you see the 9% NPL, the actual stage 1 or performing loans actually came down by 1 basis point or 1 percentage points to 80%. So you can almost see transition to stage 2, and that's through the watch list. So we did see a 2 percentage points expansion in our stage 2 loans. Why is that important? Because the IFRS rules require that you take more provisions as names start to show that level of stress. So I'm trying to share that picture so that you can almost contrast an improved NPL ratio, a higher provisions charge that you see on income.
Thank you so much for that. I see you have a question already.
No, yes. Thank you, Dennis. You know me too well. Thank you for that breakdown. I guess what I would ask as a follow-up, you mentioned there is the migration to stage 2. Maybe could you talk the velocity of that migration? Are we still seeing significant change in categorization in the last quarter, or has that slowed down? What's the momentum like in terms of categorization, especially given the context of rising interest by the central bank?
Actually, nothing out of kilter, Ronak, in terms of the riffing during the year. So we haven't seen an uptick because there was a 200 basis points rate change in December. The question is whether that has transmitted or is yet to transmit. I think we can create theories around that. And the reason why, my theory as to why we're not seeing anything kind of jump is because the rates change is not the only factor that's driven these factors and or these outcomes in the last while. So you can go back to 2022, you can go back to 2021, you can go back to 2020. And some of these have been cumulative factors. The other factor is to think about, for some of our corporate commercial customers, we actually go through a formal re-rating process. We look at factors beyond what is in their current kind of performance, and we will look at whether anything has changed in their business dynamics. So because that is scheduled, you don't quite see that jump at once. So Ronak, I haven't observed anything in the year that said, as a result of a 200 basis points change on this of December, I think towards the end of last year, there was an immediate 100 basis points or 50 basis points increasing in the NPL ratio.
Now we can move to the interest income side and maybe investment in government security. Quite a substantial increase in terms of interest income. And you can give us a flavor on that and also tell us a bit about volume growth, pricing, and over there.
Net interest income is an important revenue line for us as a bank and pretty much for every bank anyway. It is 62% of our total revenue in 2023. We would like to get that down to 50%, not by lowering it, but by accelerating and diversifying our non-interest revenue. But for now, it's 62%, and therefore it drives the outcomes that you see. With that magnitude, it grew by 35%. If you open up that net interest income, you've got a 45% increase in gross interest income. And that is basically price times volume. So let's play with those two variables. Volume contributed 2/3 of the increase in that interest income. The other third came from pricing. That pricing is a function of two things. One, we did get our risk-based pricing approval from the central bank towards the end of 2022. When we got that, we first went on the digitally disbursed facilities, implemented immediately, really, towards the end of 2022. 2023, we continue to migrate the rest of the book to risk-based pricing. And as we've been doing that, we've been resetting the base. The second thing is that the base of the risk-based price itself also changed, particularly as rates have been going up. Our base rate at the start of the year was about 12.65, if I'm not wrong. Today, it's about 14%. So those are the two factors. One, which contributes a third of the interest income, is implementation of RPP and change in the RPP base itself. And then 2/3 is volume. And I should highlight at this point, because you look at the balance sheet and say, but it's only 10%. Remember, I mentioned that we noticed customer behavior tending towards the shorter end of the curve. We did see a lot of trade facilities being drawn as we facilitated trade in our traditional China, Eastern Europe corridors. We did see that come through quite strongly. Net interest income has gross interest income and then has interest expense. Interest expense went up 72%. Now, remember, I told you NII went up 35%. The gross interest income went up 45%. But the negative side of it, interest expense went up 72%. Of course, off of a lower base, but 72%. Let me explain. So 72%, a fair part of it. Remember when I told you that we saw a shift in current and savings accounts from 86% in the previous year to 76% this year? That 10%, and given that we grew our deposits by 21%, was replaced by more expensive funding, your fixed deposit, your call deposit. And hey, that's a function of the market. If you think about 2 years ago, if you had $1 million or a few coins really in your current account, you probably wouldn't or didn't think too much about them, especially if you had upcoming expenses. Today, Stanbic is offering you 14% to place that money. If you are lucky to bid and get the last infrastructure bond, you would have gotten 18%. So we're seeing more and more customers saying, hey, can you pay something for my deposits with you? And that's the reality of the cycle where we are in. But what for me is exciting is the balance then you are able to strike. Despite rising cost of funding, we managed to expand our net interest margins by 77 basis points to 5.97 compared to 5.20 in 2022. Why is that exciting? Validates that we've been responsive to the repricing opportunities that we've had, but we've also managed how we source our funding so that we don't put the business out of shape as we seek to fulfill customer loans demand.
Let's go to the unfunded income side. What are you seeing there? And also talk a bit about the offer trading, the difference, especially in light of the recent inflation in currency in February. I think that will cause earnings for 2023, but maybe you can put that in perspective in terms of expectations for 2024.
So our non-funded income or non-interest income, I did say earlier, was 38%, or is contributes 38% of total income. That revenue line increased by 19%. There's two big components in it. The first component, which contributes about 2/3 of that revenue line, is trading. Trading has both FX and it has money market trading. That bit grew 16% year on year. Then you've got net fees and commissions. This is the fee we earn as our customers use our channels to transact. We facilitate trade. We facilitate investment banking opportunities and structuring opportunities. That revenue line went up 35% year on year. Of course, there's particular interest in FX. The 16% we saw in trading revenue, and a big part of it is FX, so I can muddle it together. All of it was volume. There wasn't an effect on margins. Why? Because if you remember, the FX market started showing signs of dislocation in the middle of 2022, around May 2022. That is when we started seeing expanded margins. And that continued into the end of the first quarter of 2023. That is when we started seeing margins kind of thinning. So when through the two periods, I isolate the impact of those expanded margins, the year-on-year impact on margins is very muted. In fact, it was a negative, very small number, so almost 0%. So the entire 16% is actually customer activity. Now, what is that customer activity? Of course, every market challenge presents opportunities. When there was, quotes and quotes, scarcity of dollars, when there was challenges in the pricing that you can get for dollars, I did get new customers that we could help either get dollars or just fulfill their dollar-denominated demands in 2022 and 2023. And we've seen that traffic continue. The way we build relationships is when we can solve our customers' need, we go beyond the transaction and try and establish a relationship. Now, we've seen those relationships stay with us. Eric, to be honest, if you ask me where will the rate be, the one thing I can tell you is markets tend to be very sentimental, but they're not emotional. The rate will respond to market factors, whether it is the market and policy factors. some of the market factors, such as the inflows that we've seen recently, as well as the policy stance that the central bank continues to take. That is the outcome where we see it today. And that continues or changes, we'll see the exchange rate get to some point. Our job managing an organization such as Stanbic is then to study that and respond appropriately by ensuring our balance sheet is properly profiled, properly funded and priced on both the liability and the asset side, and that the pricing is responsive to those market dynamics.
Before we switch over maybe to more capital allocation side of the business and more strategy, I wanted to maybe include two questions here, but both are very interesting. So one is from Kip asking, you shed light a bit on the number and value of LCs you finance under the G2G program, and your thoughts regarding the program lapsing in December, because you also said it's quite a bit of a substantial contributor to the fact that there was a loan shift from foreign to local. So maybe you can give perspective on that. And then the second question is, he's noted from the bank that it increased, you started taking the statutory loan loss reserve. The question is this indicating a thickness in resolving the NPLs, in taking additional provisions, matching counting over time? And how does the bank anticipate this line to move this year? So those two questions regarding some of the talking points we have so far. I hope you got them, and then we can respond to them.
Absolutely, I got them, and those are fantastic questions. Thank you for those questions, Maiwa. So we financed one cargo of the G2G to the tune of, I could be wrong because I know there's a dual currency piece to it, but it's just around $100 million. We did go into that transaction on the 10th of November, 2023. It has hit the 3 months of when we are supposed to have collected the cash and converted into dollars. We've already done that, and therefore we are waiting maturity in May 2024. So done, dusted, and actually very well executed. Yeah, so we're comfortable with, and we are very happy to have participated in a systemically important action that supports what the government is trying to do. Talk of that arrangement ending in December, we can leave that to the policymakers. Golf, they say, will play as it lies if and when we get there. We will continue. We are playing a much bigger role as Standard Bank, jointly with Citi, in advising the government in the wider management of debt. And therefore, if invited to think about, to help the government with thoughts around how to deal or whether to continue, discontinue, structure, restructure this arrangement, we will do our part, of course, putting the needs of the country and the mandate and the terms of reference we get from the government. But for now, it's a policy issue for the government. Statutory loan loss reserve. This is a dictate of the prudential guidelines of the central bank. The central bank has a very simple, a very clear formulaic way of determining provisions, if you like, in line with the classification of loans. It has fundamental differences with IFRS. IFRS requires a bit more complex determination of realizable value. And the central bank says, okay, I will not tell you that when you think you still have some recoverable amount, but if I say carry certain provisions that IFRS does not require because your IFRS financial statements have to tie up, I want you to carry a reserve. And this is not the first time we've done that. A couple of years back, we've found ourselves in situations like this. It will be there. It will be there as a function of the business we run. When you run a corporate 64% balance sheet that is corporate investment banking, if and when one of those customers or two of those customers hit bumps on the road, it takes more time to resolve than it is to resolve a vehicle asset finance facility, which you just go and repossess the car and sell, or a home loan, assuming it is that simple. If you're financed a project or, I don't know, a wind power or something like that, it takes a lot of time to resolve that. And in a case where we have had to take this, yes, it has taken more than the 5 years dictated by the regulator. And we've taken the provisions in line with IFRS against what the regulator wants, and the excess has been put in the statutory laws.
Rona, do you have any comments for Dennis? You can grab a glass of water in the meantime. Rona? No comment. We've clocked almost 50 minutes of the discussion. So if you have any questions, you can do three things. So one, below a pinned tweet, you can put your questions. And secondly, you can just DM us and then we'll get to see the questions. And number three, usually would allow speakers, but the conversation is very engaging and very in-depth. So we may not allow people to speak today, but the first two options are available. So Dennis, we can now dive into some more questions. One is on the dividend side and ROE. So one, I think shareholders are very happy to see the dividend. So I think go up this financial year. It is an expectation that you're building in that they should expect 50% in terms of payout ratio going forward. And then secondly, maybe that's a personal question for me. Would you consider doing buyback? Quite rare to see banks do them, especially in Kenya. So maybe you can tell us a bit about any thinking around that. So capital allocation in terms of the EPS trends and the payout ratio, and also talk a little bit about buybacks if there are any.
Okay, thank you. We made 30.75 shillings to the share in 2023, which is 34% up on 22.92 in 2022. If I go further down to 2020, we made 13.13 shillings. So one thing that gets me excited is that we declared more dividends in 2023 than the full profitability that we had in 2020. Not too far back, but it's exciting to see the quantum leap. In the last 3-4 years, we have 2.3x our profitability. So we've moved our profitability from 13.13 to 30.75, but we are 4x our dividend payout. We've moved from a dividend of 3.8 in 2020 to 15.35 in 2023. Why is that statistic important? So one of the capital management roles that we have to keep thinking about is how we optimize our capital resources and ensure that we're not sitting with idle capital. How do we determine idle capital? Number one, we think about our growth, and we have models to predict our projected growth for the year. So we go through that and ask ourselves how much capital that would demand. The second thing is, of course, we consider regulatory guidelines and we consider our internal risk limit, because beyond the regulatory guidelines, we built in some internal buffers to absorb any stresses. And talking about stresses, number three, we do go through an internal capital adequacy assessment program every year, commonly known as the ICAP. We do stress the balance sheet and the capital resources to see whether we've got sufficient resources to be able to absorb any shocks. To the extent that we can answer those three questions, we do then go and distribute as much dividend as we can. Last year, 2022, we distributed 55% of the full year earnings, 12.6 of 22.92. That's 55%. This year, cumulatively, we're distributing 50%. Previously, we've distributed 40%. In 2020, if my math doesn't fail me, we distributed 3.8 of 13. So that's almost a quarter. So it is not our target. We are not like we have to get to 50 or 43 or 67 or whatever. We are more focused on, can we continue running a vast business? Can we sustain growth? And then everything else goes to the shareholder. When we consider a buyback, it is not on the table today, or at least it is not something that has been discussed. But any capital management option is always a possibility. But I can tell you today, it is not something that we have planned.
I think shareholders are happy at least with the dividend side of things. Maybe you can tell us a bit about the performance of South Sudan and the impact on the group's overall results. And then in terms of bolstering growth in the Kenyan market, there's been talk in the past of doing some acquisitions. Is there anything you're considering, or what's the update on that? So South Sudan, the M&A position, and talk a bit about SBG. I think it had quite a good year. I look at the results. So I think those three things, and then we'll move on to the next.
The South Sudan business is safe and sound. In fact, I am always excited to talk about that business because it operates a very clear business. We know that in South Sudan, we are facilitating payment and intermediating Forex for the systemically important industries and businesses in South Sudan. i.e. For the oil and gas sector, which of course, as you may know, contributes close to 99% of the government revenue and pretty much the most dependable sector in the country. We do that business for the IDG sector, the development agencies that are in South Sudan. And then we do that for key telecommunication, key corporates that are in South Sudan, your MTNs, your Zains, your other critical players in South Sudan. That business went up 50% in profitability in 2023. It's a hallmark of strategic clarity, being very clear about the things that we are doing in South Sudan, continuing deepening relationships with those select clients that we are working with in South Sudan, and deepening our relationship with the government of South Sudan, because there's a common understanding that the business we do there drives the growth of South Sudan in line with our purpose. The SBG Securities business, this is another fantastic story to tell. This business delivered multiples of hundreds of percentages in profitability, delivered 150 million in profitability in 2023 compared to a 2 million loss in 2022. In relatively depressed equities market, the equities market activity actually went down in 2023, but this business gained significant market share from 11% in 2022 to 41% in 2023. Of course, there's a bit of a dislocation in there because part of that was one big transaction that you may be aware of. We intermediated the biggest share transfer in the history of the NSE in the first quarter of 2023, and that was all managed by SPGS. Hence, you can see then the market share come through in the profitability. So a very good performance from that business. The point around growth. So the one thing I can confirm is we do want to grow. We are intentional. This statement has been made by our chief executive, our holdings PLC chief executive. The Standard Bank Group has been intentional about wanting to grow in East Africa. That broad statement is very clear. The how and why and when then is where the variables are. And there are three broad categories or strands that you can follow to grow. You can grow organically, which if you ask me, we are not doing too badly because a 33% CAGR of the last 3 years is not necessarily childless. So quite pleased with that growth. The second way you can grow, which we're always looking at opportunities to do, is through partnerships of similar organizations as ourselves and these similar organizations, as long as we are working together to serve customers. That trend of growth also continues, and we're always looking for opportunities. And then the third is an inorganic corporate action. That has been on the table for a very long time, will continue being on the table. And it's just a question of ensuring that you can meet the basic tenets of how you want to do corporate transaction. Are your business models aligned culturally? Is there fitness, and is it financially pretty? If you can take those questions, then you should be able to do it. And that's that question in very many organizations outlives the careers of many people.
That's a comprehensive one in terms of coverage for those kind of segments. We'll move a few questions I've received here. So one is, you have some exposure to the tea sector with Egypt and Pakistan among the big buyers of Kenyan tea. Did you see any delays in terms of payments from either country, given the dollar access problems both countries have? That's one question. And then with Kenya and South Africa being graylisted by the FATF, the Financial Action Task Force, what impact is this having on your correspondent banking relationships and transactions? I know it's recent, but what are the initial sentiments around that? So those are two questions we received.
Fantastic questions. My goodness, the quality of questions here is just amazing. Thank you to the audience. I'm really grateful for the quality of questions. I think it's a decent conversation. So yeah, we are exposed to the tea sector. The biggest exposure is not necessarily on the balance sheet. Yes, we do have some exposure there, but the biggest play we have in the tea sector is actually the transaction facilitation. The tea auction in Mombasa, 80% of that tea auction happens on a Stanbic proprietary tool called the EBB. So that facilitation is actually our biggest tea play. Of course, because we have that support to the tea sector, then we do support some of the clients with their working capital needs, with their other financing needs. And like any other credits, you've got to adjust yourself as you face headwinds. So have I seen another big name come into NPL or into watch list as a result of that? Not necessarily. Have there been names that we've had to think about how we help them navigate some of the challenges? Absolutely. With the market starting to turn, I do hope we get some good news from the Fed in March. Hopefully some of those transient factors can start to correct. On graylisting, look, we do not have any impact on our correspondent banking. We use a group network of correspondent banks. South Africa is graylisted, has been for the last 1 year. Uganda was graylisted, exited the same day that we entered on the 23rd or 24th of February this year. South Sudan, which is actually a branch of Kenya, is graylisted. So not necessarily saying, oh, we're happy to be joining the club. We have the group-wide experience as an organization to navigate that and to put internal controls to ensure that we do not facilitate ML, PF, and CF risks. I guess the broader role that any financial institution that is material would want to do is to help the government or to help institutions that we have been asked to bolster their capacity to improve on that. And we'll continue to play our kind of industry role in helping shape policy to the extent that we can. Again, this is a government thing. We've got to do our part to support the country. I hasten to say, being on the grey list is not a death sentence. We were 2011, we exited in 2014. We have seen some countries like Mauritius exiting a year and a half. So it is the responsiveness that we see across all the areas that have been identified for improvement that is going to improve this, but internally, not an immediate worry.
Thank you for the really good responses on that question. So 2 more questions. So one on dollar access. I think this question that came in also says that from some of the manufacturers that he's spoken to, the dollar access problem used to be a thing of the past a bit, but Tanzania is having similar issues. And I think the exchange rate in Uganda is also moving substantially. And since you're a bit regional in terms of forecasts, do you have a flavor in terms of how dollar access is happening across the country that you operate in on some of the neighboring countries? And especially in Kenya, how are companies approaching you in terms of sorting this out? So then let's deal with the dollar access issues and the exchange rate, and then we'll come back with a few more questions.
Okay. I might not have all the answers for this one. Whoever is asking, I can try and find out the finer details on especially the apparent challenges in Tanzania and Uganda. It is not something that has come particularly to my attention, but potentially because it's not as exacerbated. In Kenya, though, I agree. We do not have any open order book that we are running. This is something that was there for a couple of the conversations I've had in the past. We do not have any of that now. We're able to meet the dollar demand. Part of it is that we've had good dollar supplies. Where you think about, what the government has received, the inflows that came in through the IF with inflation tapering in the US, remittances are up a couple of basis points. So we do not have that challenge as a bank. I'm not aware of how that is shaping up in some of the competition, but we don't have that problem. If you don't mind, I'm happy to answer the question on the regional front when I have finer details.
No worries. We'll send it later. So 2 more things, and then we'll go to year ahead if there are no more questions for the public. So one is about the demand for credit. We talked a bit about how the central bank is really trying to deal with inflation and the exchange rate that was running amok, at least in 2023. But then in terms of demand for credits, because the worry is always that if the central bank is raising rate, people reduce their demand for loans because the rates go substantially higher than what they intended to. And I think there was also a comment this week from the Kenya Bank Association chair saying something of the sort. People are taking more loans for short-term needs and less for capital expenditures and for building businesses. Maybe from your perspective and from your vantage point, what are you seeing in terms of demand for credit and applications for credit so far this year and maybe last year also? And so the second thing is about the Eurobond. You have any of that exposure on your balance sheet? And what are your perspective in terms of the fact that Kenya had to raise a bond at quite substantial rate last month, I would say. So then what's your perspective of the demand for credit and Eurobonds?
Another set of quality questions, really appreciative to where this is coming from. Demand for credits, private sector credit growth in December 2023 was 13.9% compared to 2020, 12.7%. And as it oscillated around that area, around the late singles, don't think it hit a single. Early 10. between 10 and 13% is where it has operated for the whole of 2023. I think the sentiments by esteemed banker, the KBA chair, are absolutely appropriate. That what you want to watch out in this market or in these conditions is that you don't have a lot of consumption credit, which as opposed to trade or business or expansion or investment credit, which becomes a spiral, an endless pit where you start borrowing from Peter to pay John. How do we think about that at Stanbic Bank? And I'm about to say something that's not yet in the market. But one of the things we realized is that we have a lot of customers that fall into debt traps because they borrow transactionally. I go to the mall, I spend on my credit card, which does not speak to my home loan, doesn't quite speak to my unsecured product facility, doesn't speak to the vehicle asset finance or the car loan that I have. And when all those repayments meet my salary, there's a disagreement because there's not enough money to meet all of them. And all of a sudden, I'm in a debt trap. We are coming up with a model that kind of allows the customer to monitor how that's going to work. We want to get to a point where if we avail all the credit on one channel to you and say, as Eric, based on all the data we have, you qualify for 50 million mortgage, you qualify for a 2 million credit card, you qualify for a 5 million car loan. If you go and draw down on the car loan, the rest of the limits automatically adjust. That's where we would like to get. What does that mean? You do not fall into debt trap by accident. We want to protect customers. We want to put the power in the hands of the customers. And we want to get to a point where you can even scenariolize, where you say, if I draw this, what does that happen to the rest of my ability to borrow? If we can get there, and if more banks can get there, I think we can have a more sustainable credit market, and we can start averting some of the dangers of what the KBA chair was speaking to. Yes, private sector credit growth continues. We continue to see the demand. Based on the numbers that I discussed earlier about our customer loans growth, we do continue to see that. But of course, our credit evaluation process does consider those factors. The Eurobond repayment, depending on how you want to argue it, it is a positive or it's a negative thing. I am an eternal optimist. I actually think it's a good thing for a couple of reasons. If you and I were having this call 6 months ago, half of the time we've taken here will be talking about default risk. It is no longer a conversation. I think that in that way, it's a good thing. If we were having this call 6 months ago, we'd have been discussing yields at 15 or 16%. At a yield of 10%, that's positive. Of course, it's gone up from 6.85 or something like that, which is the replacement. I think we've got to think about this in the context of the market in which we operate. The reality is those are the prevailing yields. So I know I will be quickly corrected that Ivory Coast was able to raise money at a relatively lower cost. The dynamics are very, very different. The thoughts I have about Eurobond are not necessarily a function of this June repayment, which technically is out of the way. I think the work that's going to be done is to reflect on what we have 27 paper, if I'm not wrong. We've got a 28 paper. I think the paper that has been obtained now starts to repay or repays in 29 or 30. We have a 32 paper. We have a 34 paper. And I think we have a 48 paper. Those are upcoming maturities of Eurobonds. I think if someone is looking at this thing critically, they need to think through that spectrum of how do we buttress our productivity as an economy? How do we buttress our fiscal resource mobilization as an economy? How do we buttress productivity of the credit that we've taken, the output thereof, so that then we can be able to manage that? We cannot take a 2024 to 2026 view on this, unfortunately.
All right. Now, small break again for Dennis. A few thoughts from Ronak, and then we'll come back to Dennis and wind up. Any thoughts so far?
No. As always, Dennis has been comprehensive, and I totally agree with him. The yield on the new Eurobond, while not ideal, I think the fact that it's taken away the default risk on Kenya sovereigns, I think is a big positive, and hopefully that translates to increased foreign investor confidence and catalyzes more inflows into the economy. If I would just have maybe one last question. And again, this is very broad and doesn't specifically relate to Stanbic. But Dennis, I'm not sure if you had a chance to go through the recent IMF update on the country. And in that, there was, I would say, a bit of an alarming statement by the IMF suggesting that if the FX rate were to further depreciate significantly, then there would be 3 tier 1 banks. Their capital positions would come under pressure and that they would need to raise capital. Personally, I found that surprising, given the capital adequacy ratios for most of the tier 1 banks, barring maybe 1 or 2. But maybe just wanted your thoughts on that statement.
Look, the beauty of being a market commentator, it's a game of ratios and numbers, and you cannot blame the commentator for not having the detail because they're not privileged to have that. Every organization today, and I'm just speaking from an absolute point of ignorance on how organizations or banks run their treasury and capital management desks, which is part of my responsibility in the bank. But the one scenario analysis that every organization must be doing is to say at what point or where would the currency depreciate to trigger alarm bells on capital. And if that were to happen, what would be the response? What would be the capital mobilization? What would be the capital raising? And actually, if you believe that those scenarios, for example, if that scenario was 180 to the Kenyan shilling, to the dollar, and according to your internal research or market research, there is a risk that the dollar would get to 180, then every treasury and capital market management desk would have to think, okay, how do I think about dividends in that case? So I think the broad stroke comments are relevant and merited, but then someone's got to get into the details of the book because then you need to start unpacking. Okay, but what is the profile of funding that bank has? Is there any that's potentially, especially tier 2, is FCY? If it's FCY, then it's inflating with the rate. And I know you probably talk about core capital. But is there any that is inflating as the currency depreciates or the reverse? That's our consideration. What is the profile of the balance sheet? Is it capital intensive? If my balance sheet is mostly term funding vis-a-vis Bank B, whose balance sheet is mostly interbank placements and mostly mortgages, then the risk-weighted assets demand is slightly different. So you've got to get to those details before you come out to that answer. But broad comments are good. You just need to subject them to some context.
I guess with the fact that you've paid a 50% dividend suggests that you're quite comfortable regardless of where the currency. So that's good to know. Thank you.
Yeah. So the third vector or analysis that I spoke to before we come to a dividend, the third factor I spoke to is stress. And those stress scenarios, of course, include at what point the currency would get us into some challenges. And we think, having projected that, we are comfortable. Today, we are 250 basis points above CET1 demand by the regulator. And we think that is sufficient buffer.
Thank you so much. There's a small question here about the percentage of forex income and NFI and how much can be accounted for.
That's something you have off the top of your head? Percentage or forex income to NFI, non-funded income?
Of the total non-funded income, about 2/3 on broad strokes is trading income. Now, I should highlight, however, that trading income has some money market play, so it's not entirely FX. So I would say something in the region of 55 to 65 odd percentage.
Yeah, almost at the tail end of the questions. So more to do with strategic thinking around 2024. What's your focus areas as we go into 2024 as a management team and as a bank? What are some of the things that you're focused on for growth, and share a bit of your expectations as we head into 2024 on the Kenyan economy and on Stanbic? What can we expect going forward? And then also you can speak to that expectations in line with your 2024 to 2026 strategy, now that you complete the 2020 to 2023 strategy implementation. These are really good results, but what can we expect going forward?
So the economy is expected to continue growing, and that's positive. I did read, I don't know whether it's IMF or who's predicted the economy will grow by 5.1% in 2024 and probably in the same region in 2025. Compare that to the global economy, which is expected to grow by, I think, 2.9% in 2024 and something similar in 2025. So it's still exciting to be in this part of the geography. The economy continues to grow. There will be challenges. The job of those of us who are privileged to be in these industries is to manage those challenges and the risks that come with them. We've built our 2024 to 2026 strategy on the strength of our 2020 to 2023 strategy. We did think that it does not make sense for us to change our strategic. So our strategic priorities will continue being focusing on transformation of our client experience. If our clients were happy with the platforms that we have availed them, we are about to make them happier because we're going to continue refining and fine-tuning and getting those closer to them. We just want to delight our clients with the experience we give them. We're going to continue focusing on executing our strategy with excellence. We're going to continue paying attention to internal operational efficiency. Usually in a market where you cannot transmit your cost of sales effectively in a manufacturing language through to your sales or to your pricing, you've got to think about your cost of operations. So we're going to continue investing in being more and more efficient in the cost that are borne by the business. By that, we mean how do we empower our people to be more productive? By that, we mean how do we ensure that we are harnessing the power of technology and the investments that we've made over the last while. And then we are going to continue being deliberate about sustainability. And I didn't speak to this in my earlier sentiments, but it is always exciting to match 33% CAGR of the last 3 years, 1,536 MSMEs that want grants and catalytic funding in that same period to go and start their businesses, because those are the SMEs, those are the commercial clients, those are the businesses, those are the corporates of tomorrow. So that piece is exciting. It is exciting to talk about 33% CAGR, but also talk about 4,705 people of cancer for free over the same period, because that helps us to continue living our purpose in the countries, and a lot more work that is being done by the foundation. It's just under 19.3 billion. My head of investor relations is going to correct me tomorrow if I don't get the numbers right. About 19.3 billion to empowering women through our data program, which continues to be trailblazing in the market. We're going to continue focusing on those three broad strategic priorities. What we've done in this new strategy is then to refine our focus for the 4 business units that we run. We've got a corporate investment banking, a business. We want that business to do a lot more work for our local corporates, because Kenya has local corporates that are winners. So we will see that coming through. We've got a business and commercial clients business. We want that business to do more for our SMEs and to do more in the ecosystem world for following some of our corporates. We have a personal and private banking business. We want to grow that business into a superior client experience, delightful experience, private bank. We actually want to be a leading private bank, not only in Kenya, but in all of Africa. And we've built some of those capabilities in the past, but we want to bring them to life right about now. And then we've got the 4th pillar, which is our insurance and asset management business. We want to build that business. We've got an insurance intermediary business that's in there. We want to build the rest of that around asset management, around investment management going into the future. So you will see a lot of that activity at the business unit level driving growth in that regard. In terms of metrics that matter and the outcomes that we want to see, I think if we get to an ROE of between 23 and 25% in the next 3 years, I think we'll deserve some, I want to say champagne, but I'm not very confident to that. But I think it'll be a good outcome if we can keep our cost to income ratio between the 42-43% area. I think that would be decent without cutting our nose to spite our face. I think that region for us would be great. We want to grow our revenue around 15, 16, 18% area. So those are the metrics that we want to see into the future. And then, of course, sustainably. We are very clear about the work that we want to do about sustainability. We want to get to a net zero as a Standard Bank group in the near future. And we're going to work towards that. I think I started by answering on the outlook, so I pause there.
Thank you so much, Dennis, once again. Do you have any final comments before I give it back to him to give us his closing thoughts?
No, I just think we should have started the call with the comments he made at the end. Stanbic want to become a top 3 backed by market share, 23% ROE, 50% dividend. Yeah, we should have just had a 5-minute call and call it a day, because that's very impressive. Thanks for your responses. As always, Dennis, very engaging, and congratulations on the results once again, and best of luck. Seems like you guys are pretty ambitious. So far has been pretty good, and hopefully it will continue to be. Thank you, Ron.
Dennis, I'll give it back to you to give us your closing thoughts in terms of shaping up the conversation and what your thoughts are. And then I'll give you some closing comments and then we'll be done.
Fantastic. Thanks, Eric, for affording me the opportunity. Thanks for the engagement, Ronak. Thank you, Catherine, for being here to supervise what I am doing. And thank you, everyone who's made the time. I think you had a lot of options of other important things to do. I should listen to a faceless accountant. But look, we are very excited about the results we have been able to deliver. I am eternally grateful to my colleagues at the bank. I see people determined to make dreams come true, whether it's to facilitate that home ownership, facilitate that car ownership, facilitate that investment opportunity, facilitate protection through insurance intermediation, facilitate that trade, someone an SME trying to get some goods from China. And that for me is the difference between the 18.6% ROE that we returned and the owner of that capital putting it in the IFB and getting pretty much the same return, the most recent similar yield. The return that we're able to manufacture comes with a lot more kind of other benefits to the customers that we interact with. And therefore, I just want to echo the words of my chief executive earlier this morning when we spoke to the media and investors. He said, we've set the base for 2020, between 2021 and 2023. We're very clear on where we're going in 2024. We are going to be razor sharp in executing our strategy, and the holy trinity of executing our strategy, taking advantage of marketing opportunities and surmounting the challenges that come our way will be the keys to our success in the coming days. Asanteni sana. Thank you, Eric.
Thank you so much, Dennis. I think I should commend Stanbic for 2 things. So maybe you should check this home. One, that you're the first bank to report earnings. I think this is pretty early in the season. Give people time to digest the earnings. So we commend you for that and for staying early when you're reporting. I think we knew last month that you were reporting in the first week of this month. So it's very commendable, that going. And secondly, also, we commend you also for taking time to come to spaces to discuss with retail investors and curious people like Ronak and I on all this and answering questions really candidly. So we wish you well in the really ambitious ambitions. We want to keep you accountable. We'll keep those numbers, the targets you've given up, and then we'll come back in a few years. Thank you so much for taking your time. Really a pleasure. Unless Ronak has anything else to add, I say asante. Ronak, anything else?
No, nothing from me. And thanks, Dennis, once again for bearing with my questions this evening.
All right. On that note, I say thank you so much for joining us. And thank you for your team from Stanbic who have helped make these spaces possible. And thank you for all the listeners who joined in. We'll host more banks earnings for the rest of the earnings season. So look out for our analysis of that. It's a very busy period between now and the end of the month. So it's good to catch up and see where you can put your money in terms of investments.